Good morning. Welcome to Stock Market Today and happy Friday, July 31st, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the great content for this show. Also give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So U.S. equities were mostly lower in Thursday's trading as second quarter GDP came in at an astonishing decline of 32.9% quarter over quarter. That's on an annualized, seasonally adjusted basis. Additionally, initial and continuing claims moved higher for a second consecutive week. Treasuries were stronger with the curve flattening. The dollar was weaker on the yen and euro crosses. Gold finished down 60 basis points after 8 straight sessions of gains. Crude oil settled down 3.3%, and finished below $40 a barrel. As we get to the desk this morning, futures are slightly higher after Asian markets were mostly weaker overnight. European markets are seeing some good gains after the Stoxx 600 fell the most in over a month on Thursday. Treasuries are stronger across the curve. The dollar is weaker against the yen and the euro. The dollar index is on track for its biggest monthly decline in a decade. Gold is up 1.5%, continuing its assault, and WTI crude is up 30 basis points to kick us off on the final trading day of the month and the week. And the structure of the S&P 500, well, if they're going to break out, today would be the day to do it. On the heels of those monster earnings reports from Google, Facebook, Amazon, and Apple. This would be the day. At the very least, today would be the day for growth to start reasserting, which we think is taking place. But if we look at the structure of the S&P, realistically coming into the day, it remains the same. 3,000 to 3,100 remains solid support. Resistance in the 3,250 to 3,350 range, with the highs continuing to play as long as support holds and we are above it. And thus far, that is the case. Small divergence still in play for the CCI, the 13-period CCI. A break above the recent highs would likely take that off the board. Chaikin money flow remains bullish and is continuing to move higher. So, as we grind through earnings season, not a ton has changed. Continuing to press on the top end of the range for the S&P 500. Weight of the evidence continues to support a move back to at least the February highs. That remains our base case for the time being. And again, I think, the catalyst was those big prints last night. That should get things going. And hopefully we'll see some follow through if you're bullish. If you're bearish, you have to start thinking about how you manage risk if the market does break top side. Let's take a look at our market in a minute now. What are we writing about in the note today? Well, the GDP report, which was widely expected to be a disaster. I think it was more the claims data that sent stocks lower on the day yesterday, as initial and continuing claims ticked higher for a second consecutive week. But after the close last night, the big four delivered. They got the job done with their massive earnings reports. Large cap growth could be set to reassert its leadership on the heels of that catalyst. And it's interesting that that's playing out as the copper and gold ratio continues to fade. As we said earlier, futures do point to a higher open here today. Taking a look at the major indices now and their power bars, the Dow lost 86 basis points yesterday to send the power bar back to a neutral position of 7 bulls to 7 bears. S&P 500 down 35 bips, 158 to 81 bulls to bears there. The NASDAQ was the only major market that was higher on the day yesterday, 38 to 6 bulls to bears after tacking on 50 basis points. Small caps, an inline performer with the S&P to the downside, 608 to 286 bulls to bears there. Bonds uptick, sending yields lower. According to the Chaikin Power Bar, small cap stocks and large cap stocks do remain bullish. Across the board, major markets are mixed. Let's hit our stock of the day now. I don't like to make a stock of the day a name that's had, names that have had obvious good news and are already gapping higher. We've talked about our view on growth. We've talked about our view on these big fan mag stocks. Obviously, we're going to see some action in that group today, but Microsoft looks compelling to me from a setup standpoint. If growth, especially large growth, which we'll look at a little bit later on in the show, is going to begin to reassert, Microsoft is likely going to go along for that ride as well, right? MSFT closed down 8 basis points yesterday, has a bullish rating, strong trend above the rising trend line, strong industry group. We all know what software has to say. But the setup to me is compelling because as these growth stocks and these big leaders have pulled back a bit and there's been a little bit of a rotation, Microsoft has pulled back to the rising trend line and become oversold. Bullish stock outperforming oversold bullish money flow. I like that setup. So we're highlighting Microsoft in our note today. We're highlighting it here on the show. You can kind of, from a technical perspective, you can see you can kind of shoot against this 190 to 195 range in the near term to frame up risk and reward, or at least the downside risk potential. But the trend to the upside is very much intact here. Large cap growth in a position to reassert its leadership characteristics after a few weeks of rotation. So take a look at a name like Microsoft if you're looking to add some bullish exposure. I think the setup here is fairly compelling. Turning now to the sector tracker, the movement of the major sectors over the last 5 days. REITs remain at the top of the list, and that's kind of interesting. Tech jumps into the number 2 slot. Solid day yesterday from the semiconductors. That print from Qualcomm really helped that group, and that's aiding the technology sector. Staples, discretionary comms, and utilities are also higher over the last 5 days of trading. So not a ton of information there. Just, kind of, it is what it is. Sometimes in the short term, things get a little bit jumbled up. You don't get a lot of information. What we do see at the bottom of the list, though, energy, disaster, materials looks like it's counter trend in nature. We continue to favor the materials as the best cyclical group, especially in light of the fact that we see rising inflation. Financials going to be tough for the financials to get going, in my opinion. The Fed told you they're going to keep rates under pressure. Banks likely to have a tough time, at least on a relative basis, in that environment. Industrials and healthcare also lower over the past 5 days of trading. Turning now to the industry in focus, which has been a good one. It's biotech. Over the past 6 months, it's outperformed the S&P 500 by nearly 18%. Power bar ratio is strong, 32 bulls to 25 bears there. Number 15 of 21 subsectors, and it has moved down 3 slots over the past week. But if you're looking for some compelling names as potential ideas after doing more research, Alexion, ALXN, very bullish. Voyager Therapeutics, VYGR, very bullish here at Chaikin Analytics. And Retrofin, RTRX, also with a very bullish rating within our 20-factor model, and kind of similar to the chart of Microsoft, if you will. XBI is the ETF that we're looking at to frame up this industry group. It has a bullish ETF power gauge rating, and the trend is strong as we are above this rising long-term trend line. What we see here is a near-term pullback, right? The leaders, bit of a rotation. You can see the support level right here, 105 to 110. Actually 100 below that as well. So you have some solid support down below for this fund that is now oversold within the context of its uptrend, right? If we think about the overbought, oversold indicator, get a lot of questions on it. The way I like to frame it up is it tells you where is the stock within the context of its trend, right? So if we're going to say this constitutes an uptrend, the stock is oversold within this trend. That's a compelling setup. Chaikin money flow is bullish. I think you want to take a look. If you trade ETFs, XBI looks pretty compelling here. Also probably makes sense to drill down on some of the holdings and identify those bullish and very bullish stocks that have the potential to lead the market. Taking a look at what's trending now, yesterday's S&P 500 gainers and losers, predominantly earnings related. On the winner side of the board, APA up 17.3%, Qualcomm, big print out of them, up 15%, UPS, earnings report sent that stock higher by 14%, plus Qorvo in the semiconductor space. So Qualcomm and Qorvo, part of that semiconductor group. QRVO, very bullish stock, up 11.6%. Hologix in the med tech space, very bullish stock, up nearly 9% on the day. The loser side of the board, A.O. Smith down 8.7% on earnings. Oxy, some news of an asset sale, takes 7.4% out of that stock. WRK, Westrock, didn't see anything company specific to drive that stock lower on the day. COP and Valero, part of the energy space, reported earnings. Both companies reported earnings yesterday, and their stocks both down over 5.5%. So it is earnings season. The micro is driving a lot of the story right now, with the macro seemingly on the back burner for the time being. Always kind of bubbling there under the surface, but it's a micro market right now as we are in the heart of earnings season. So let's get into it. We've said for a long time, and by a long time I mean the past few weeks, that we thought that this rotation trade was merely position squaring, that the growth trade was extended to the upside, it was crowded, and about 3 weeks ago we wrote, don't chase it. Don't chase it. It's extended to the upside, growth over value, just don't chase. Okay? Not chasing it has paid off as the group has consolidated on an absolute basis and slightly underperformed on a relative basis over the past 3 months. But the stage is set for it to reassert. So if we take a look at a fund like IWF, the iShares Russell 1000 growth ETF, so your proxy for large cap growth, you can see it was only a consolidation on an absolute basis. Fund is consolidating above the breakout level, above a rising 50-day moving average, above the rising 200-day moving average, and essentially just kind of worked off an overbought position. If we look at the 13-period CCI, right? Came overbought, became extended, had to consolidate, right? On an absolute basis, it looks like, a pause. On a relative basis, it did have a bit of a downtick. No two ways about it. That happened. But no real damage done, as relative to the SPY, IWF has remained above that rising trend line and above the breakout levels. So with Google reporting, Facebook reporting, Amazon and Apple both reporting last night, all four companies blow out numbers, all four companies trading higher, it stands to reason that this large cap growth theme has a catalyst to reassert its leadership position. And that's been our case. We've stuck with it. Likely going to start to play out. So when we're thinking about ideas, when we're thinking about how you want to be positioned in the marketplace, favoring large cap growth remains a quality strategy. And it's interesting how the market sniffs these things out. Because this copper to gold ratio about a week ago hit its head on a declining 50-day moving average, started to move lower, and that continues. RSI breaks a near-term uptrend. Okay, so this is, why do you want to own growth? Because there's no growth in the world. Because growth has been slowing, right? This has been my theme. I pound the table on it. And I'll continue to pound the table on it until the evidence suggests that I should stop pounding the table on it. But the simple fact of the matter is, this is a trend to the downside. All right, I've said it before, I'll say it again. It didn't start with COVID. COVID was an accelerant. This trend was firmly in place long before COVID was an issue. Okay, and it's played out largely as the 10-year yield at the bottom of the chart there has fallen through the floor. Okay, and it's continuing lower now. And after, so again, but not new. Trend's been in place since late 2018. Accelerant to the downside with COVID, a little bit of a consolidation, and now moving lower once again. Folks, there's no growth in the world. So investors are bidding up treasuries and they're bidding up growth stocks. And that continues to be a solid strategy if you're running a diversified portfolio, which I think everybody should. The question is, will they reach for yield? Here's high yield relative to treasuries moving higher, still below the breakdown level, still below the declining 200-day moving average, but a potential RSI shift here for the ratio as bond yields move lower. I don't love the strategy in light of the economics in the world and in light of the likely continued spike in bankruptcies. But right now, you're getting a bit of a relief rally in high yield relative to treasuries. I think similar to growth versus value, though, meeting this 200-day moving average is likely to be a pause. So that's going to wrap us for today. I hope you all have a great weekend. Take us for a test drive, shakenanalytics.com/test drive. I'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.